Are you tired of feeling anxious about your investments? Are you ready to take control of your financial future? Well, you've come to the right place. In this video, we'll be discussing the importance of diversification in investing. By the end of this video, you'll have a better understanding of how to create a diversified investment portfolio that will help you achieve your financial goals. The risks of investing in a single asset. It's always exciting to think about the potential returns from a single investment, especially if it's been performing well. But have you ever thought about what would happen if that investment suddenly took a turn for the worse? By investing all of your money in a single asset, you're also taking on a large amount of risk. It's like putting all your eggs in one basket. This is especially true when it comes to individual stocks. You may have heard stories of people who invested all their savings in a single stock, only to see its value plummet. Just think about it. If you had invested all your money in a stock like Enron or Lehman Brothers, you would have lost everything. But don't worry, this is where diversification comes in. By spreading your investments across different assets, you'll be better protected in the event of a market downturn. In short, diversifying your investments helps spread the risk, giving you a safety net for your financial future. The benefits of diversification. Diversification is like having a financial insurance policy. It helps to reduce the overall risk in your portfolio and increase your chances of earning higher returns. By spreading your investments across different assets, sectors, and geographies, you'll be better protected in the event of a market downturn. And when one part of your portfolio is down, the other parts will help to balance it out. Additionally, diversification allows you to take advantage of different market conditions and trends. By investing in a variety of assets, you'll be able to capitalize on the strengths of each one. And the best part is, it's not just about protecting yourself from losses. Diversification can also help you earn more money. Studies have shown that a well-diversified portfolio has the potential to earn higher returns over time. So whether you're saving for retirement or working towards a big purchase, diversification is the key to achieving your financial goals. Overall, diversification is a smart and effective strategy that can lead to a happy and secure financial future. How to diversify your investment portfolio. Now that you understand the benefits of diversification, you may be wondering how to get started. Well, the good news is that diversifying your investments is easier than you may think. One way to diversify is to invest in mutual funds or exchange-traded funds, ETs, which are baskets of investments that are managed by professionals. These can be an easy and convenient way to gain exposure to a variety of different assets and sectors. Another way is to invest in index funds, which track a specific market index such as the S&P 500. This allows you to own a small piece of many different companies at once. You can also diversify by allocating your investments across different asset classes such as stocks, bonds, and real estate. And don't forget about diversifying geographically. It means investing in different countries and regions. And remember, diversification is not a one-time thing. It's something you should continually review and adjust as needed. It's important to regularly review your portfolio and ensure that it's in line with your investment goals and risk tolerance. Diversifying your investments can feel daunting, but it doesn't have to be. With a little planning and research, you'll be on your way to creating a diversified portfolio that will help you achieve your financial goals. Diversification and modern portfolio theory. Have you ever heard of modern portfolio theory, MT? It's a Nobel Prize-winning concept that helps investors understand the relationship between risk and return in investing. And guess what? Diversification is a key component of MT. MT states that by diversifying your investments, you can achieve a more efficient portfolio with a higher expected return for a given level of risk. In other words, MT helps you to understand that diversification is not only about spreading risk, but also about maximizing returns. MT also suggests that by diversifying your portfolio, you can create a portfolio that has a higher expected return for a given level of risk or a lower level of risk for a given expected return. So, not only does diversification reduce the overall risk in your portfolio, but it also helps you to create a portfolio that has the potential to earn higher returns. It's a win-win situation. Overall, MT and diversification are a powerful combination that can help you achieve your financial goals and sleep well at night. Diversification and behavioral finance. Have you ever heard of the term behavioral finance? It's the study of how psychology and emotions affect investment decisions. And unfortunately, our emotions and biases can sometimes lead us to make undiversified investments. For example, many people have a tendency to chase hot stocks or invest in companies they are familiar with, regardless of whether it fits in their overall portfolio strategy. But here's the good news. By understanding the common behavioral biases that can lead to undiversified investments, you can take steps to avoid them. For example, by setting clear investment goals and sticking to a diversified investment strategy, you can avoid the herd mentality that can lead to chasing hot stocks or sectors. And by regularly reviewing your portfolio and ensuring that it's in line with your investment goals and risk tolerance, you can avoid confirmation bias, which is the tendency to hold on to losing investments in the hope that they will eventually recover. Diversification and behavioral finance may seem unrelated, but in fact, they complement each other perfectly. By diversifying your investments, you'll be better protected from the emotional and psychological biases that can lead to poor investment decisions. Overall, diversification and behavioral finance are powerful tools that can help you to achieve your financial goals and make rational investment decisions. Over-diversification and its consequences. We'll get to that in a second. I have a favor to ask of you. If you like this video so far, please subscribe to the channel. Diversification is a great strategy to reduce risk, but it's possible to have too much of a good thing. Over-diversification is a term used to describe a portfolio that holds too many different investments, often resulting in a lack of concentration in any one area. Having too many investments can lead to a diluted portfolio and make it difficult to achieve the desired returns. This is because it can lead to increased costs, such as higher management fees, and make it harder to keep track of your investments. But don't worry, this is where the balance comes in. It's important to find the right balance between diversifying enough to reduce risk, but not so much that it dilutes your portfolio. One way to determine the optimal level of diversification for your portfolio is to consult with a financial advisor. They can help you to assess your risk tolerance and investment goals and create a diversified portfolio that's tailored to your specific needs. And remember, diversification is not a one-time thing. It's something that you should continually review and adjust as needed. Overall, diversification is a great strategy to reduce risk, but it's important to find the right balance and not to overdo it. With the right balance, you'll be on your way to achieving your financial goals and enjoying a happy and secure financial future. Putting it all together, a case study. Now that you've learned about the importance of diversification, you may be wondering how it all comes together in real life. Well, let's take a look at a case study of an individual who starts with a single stock investment and gradually diversifies their portfolio over time. Let's call this individual Samantha. When Samantha first started investing, she put all of her money into a single stock that had been performing well. She was thrilled with the returns she was seeing and felt confident that her investment would continue to perform well. But as time went on, the stock's value began to drop and Samantha started to feel anxious. She realized that she had put all of her eggs in one basket and that her lack of diversification left her vulnerable to market fluctuations. That's when Samantha decided to take control of her financial future and start diversifying her investments. She began by investing in a diversified mutual fund, which gave her exposure to a variety of different stocks and sectors. Over time, Samantha continued to diversify her portfolio by adding index funds, bonds, and real estate investments. She also diversified geographically by investing in different countries and regions. By the end of the case study, Samantha's portfolio had grown significantly, and she felt much more secure knowing that her investments were diversified. The case study shows that diversification is a powerful tool that can help you achieve your financial goals. And the best part is, it's never too late to start. Overall, diversification is the key to a happy and secure financial future. And this case study is the perfect example of how diversifying your investments can lead to greater returns and less stress. We've covered a lot of information, from the risks of investing in a single asset to the benefits of diversification and how to create a diversified investment portfolio. We've also talked about the relationship between diversification and modern portfolio theory, behavioral finance, and the consequences of over-diversification. By now, you should have a better understanding of the importance of diversifying your investments to reduce risk and increase returns. You should also have a better understanding of how to create a diversified portfolio that will help you achieve your financial goals. Remember, diversification is not a one-time thing. It's something that you should continually review and adjust as needed. And don't forget to consult with a financial advisor before making any investment decisions. But the journey doesn't end here. If you're ready to start improving your financial well-being, take action now. Check the first link in the description for our Frugal Living ebook. Our comprehensive guide covers everything you need to know about living a frugal and rewarding life, including creating a budget, identifying areas for cost-cutting, and finding affordable alternatives to everyday expenses. It's never too late to start making smart financial decisions.